Hello guys, so this is going to be the last part of part one of the intro videos. So now we are on to what is a trend. Um, I know this video looks a little, this looks a little bit like a lot, but I'm going to break it down to you so that you understand what you're looking at. So what is a trend, right? There's two types of trends we look at in the market. There's an uptrend and then there's a downtrend. When you are looking at an uptrend, they call them the bullish trends. It is going upwards for a buy. Anytime you see an upward trend, you want to go in for a buy. When you see the market elevating up in blue, you want to go for a buy. Okay? I hope that's making sense. And it's the reverse for when you're doing a downtrend. Downtrends are bearish looking movements. When you're doing a downtrend, you will want to go in for a sell. So if you enter the market here and you see it going down like so, down like so, down like so, down like so, the downtrends will always be in red. Those are considered bearish movements. Buys and uptrends are considered bullish or blue movements. Now, to get into all that you see marked up on the chart. So in green, we have our entry points for the market. So when you enter the market, wherever you enter the market at is where you start to see your trend for your trade, right? So you will set a stop loss in the position that you are willing to risk, right? If you are in an uptrend for a buy, you would want to put your stop loss below your entry point at the lowest point that trend has previously hit. You don't want to give it a chance, so as soon as you enter the market, if it hits your stop loss, you would lose money. You want to make sure that you are watching the previous trend of that market, whether you go back a couple of days, a couple of weeks, to see how low it's hit in the past in order to come up with a good guess as to where to place your stop loss. Also remember, you are placing your stop loss based off of how much money you personally are willing to lose in consideration of the ratio you are willing to win. So you cannot expect to win $50 if you're not willing to lose at least 10 of that 50. I hope that makes sense. When you are setting up your stop loss, right, and you have entered the market, that's just to help you minimize your losses. Your stop loss is to help you help you confirm that you are only willing to lose a certain amount. You can modify that once you see the market going in the direction you would like. So once you see the market moving up in an uptrend and it hits your TP1, your TP1 is your take profit. It is the first layer on the market that you are willing to make profit from. That is your first level or boundary that the trade hits in order for you to make your money. Once you see it going in that direction, you can now move your stop loss to your entry point so that when it comes back down, you keep the profits you made from your take profit one. If it continues to rises, right? If it continues to go in the upward trend and you notice that it's going to keep going up and it's going to keep going up based off of the confirmations you have placed in your trading plan, then you will able to move your stop loss up some more to your TP1 in order for you to maximize your profits. I hope that is making sense to you. You can also do the same thing for your downtrend. It's just in the reverse matter. So when you enter into the market and you see the market is going on a downtrend, downtrends are what? Are sells. So when you go down to your downtrend and it hits your take profit one, you can move your stop loss that is above your entry point. You can move your stop loss to your entry point in order to maximize your profits and minimize your losses. I'm hoping that makes sense to you guys. If not, please write me. Please let me know where it's not making sense to you. I do also want you to look at this section in the market that you will see quite often. This little transition zone right here where it's blue, then red, blue, then red, blue, blue, red, red, and then it goes down and then it shoots back up. I want you to take note of that. That is called the transition zone, also known as consolidation. That period is when the market is indecisive in which direction it's trying to go. There's two ways that it can go. It can go into consolidation and shoot down when you're in for a buy, which is not a good thing. If it was to continue to go down, it would hit your stop loss, right? So that you can only lose whatever you set to lose, period, right? Then it will go back up, or whatever the market is, it will go back up, and then that's where the trend will continue. Every market has a consolidation point. This is something you cannot avoid. Every market has one. It's just choosing when the best time to look at them. Some of them are good indicators to let you know if that market is worth getting into or not. If you see a market that has a lot of consolidation in it, you do not want to enter that market. And so on and so forth. So if you need any more help understanding what a trend is, please let me know. I can do a conference call on this so that you understand how to mark up your charts and all those other confirmations you may need, okay? Yeah, so let me know.